Cryptocurrency for beginners. A digital money created to function as a means of trade is cryptocurrency, commonly referred to as crypto. In addition to controlling the production of new units of a certain digital currency, it employs encryption to safeguard and verify transactions. Blockchain technology, a distributed ledger enforced by a global network of computers, is the foundation of several cryptocurrencies. Because no central authority issues cryptocurrencies, they differ from fiat currencies like the US dollar or the British pound, rendering them potentially resistant to interference from or manipulation by the government. To better grasp the cutting-edge financial innovation, this post will go through numerous cryptocurrency principles. What is the process of cryptocurrency? Most cryptocurrencies run well without the support of a government or central bank. The functioning of cryptocurrencies is supported by decentralized technology called blockchain, as opposed to depending on assurances from the government. Bitcoins are not a collection of bills or coins. Think of them as virtual tokens, the worth of which is determined by the forces of the market established by individuals looking to buy or sell them. The practice of mining, which involves using computer processing power to solve challenging mathematical problems in order to earn coins, creates cryptocurrency. Users may also buy the currencies from brokers, store them in encrypted wallets, and use them to make purchases. Consensus algorithms that use proof of work, POW, or proof of stake, POS, commonly power blockchains. POW relies on miners, who frequently dedicate particular computing devices for the activity. Staking, on the other hand, powers POS. By keeping assets in certain authorized wallets, incentives are given out under the staking mechanism to assist in maintaining the network. Many POS assets also support masternodes, a more complex staking method that often needs a minimum quantity of coins. Who historically has had an influence on cryptocurrencies? Over the years, a number of individuals have had a big effect on the Bitcoin sector. Bitcoin, BTC, which was created by Satoshi Nakamoto, served as the industry's catalyst. Vitalik Buterin, who is best known for creating Ethereum, ETH, has had a significant influence on the cryptocurrency movement. With Ethereum comes a new class of additional tokens called ERC-20 tokens that were produced on its network. Due to the establishment of Mt. Gox, a location that regularly hosted Bitcoin trading despite its initial purpose as a center for players of the game Magic: The Gathering, Jed McCaleb contributed to Bitcoin's rise to popularity in the industry's early years. However, the platform's collapse in 2014 made it notorious. As one of the founding members of Binance, which has developed into one of the biggest crypto exchanges, Changpeng Zhao improved the accessibility of digital assets. Many other people have also left their imprint on the sector, and Cointelegraph has included some of them in its list of the top 100 figures in blockchain and cryptocurrency for 2021. How come cryptocurrencies are so unstable? Due to the industry's youth, there is a lot of volatility in the cryptocurrency field. Investors want to play with their capital in order to make quick money and learn how cryptocurrency values fluctuate and whether they are affected by them. Cryptocurrency prices are influenced by how many people use them, i.e., their usefulness, and for what purposes. If more individuals utilize them to make purchases as opposed to merely keeping them, the price will increase. The scarcity of cryptocurrencies also influences their value. This speaks to the limited mechanism of the cryptocurrency. The maximum number of bitcoins that may be mined is 21 million, according to the Bitcoin protocol. Bitcoin's price will therefore rise as its scarcity inevitably rises as more individuals enter the cryptocurrency industry. By obliterating a percentage of the supply, some coins also employ the burning process to raise their value. A cryptocurrency's price may fall if large accounts start selling their holdings. Because of their substantial positions and potential to move the market if a group of people decides to sell crypto assets, these accounts are referred to as whales. Types of cryptocurrency. Coins are made on their own blockchain and are intended to be used as a kind of currency. For instance, the Ethereum blockchain forms the foundation for the cryptocurrency Ether. Any blockchain-based cryptocurrency that isn't Bitcoin is referred to as an altcoin. As a shortened version of alternative to Bitcoin, the name altcoin was developed, and the great majority of altcoins were developed to enhance Bitcoin in some way. Examples of alternative currency include Namecoin, Peercoin, Litecoin, LTC, Ethereum, and USD Coin, USDC. Some cryptocurrencies, such as Bitcoin, have a limited supply of coins, which helps to increase demand and support the idea that they are worth something. For instance, the creators of Bitcoin decided that the total quantity of Bitcoin should be limited to 21 million. Although they are constructed on an existing blockchain, tokens are thought of as programmable assets that permit the creation and execution of certain smart contracts. These contracts can be used to prove asset ownership outside the blockchain network. Tokens may be sent and received and can be used to represent several types of value, including money, coins, digital assets, and power. The values of stablecoins are linked to other fiat currencies or assets, like gold. Stablecoins provide customers a mechanism to sell into an asset with the same value as a national currency, most frequently pegged 1-to-1 with the US dollar. Yet one that can still be used inside the ecosystem for transactions and storage in a way that resembles cryptography. Another sort of cryptocurrency is called a non-fungible token, or NFT, which stands for a unique asset that cannot be replaced. For instance, a Bitcoin is fungible, which means you may swap one for another and obtain the exact same product. On the other side, a unique trade card cannot be reproduced. If you exchanged it for a new card, you would receive something completely different. Depending on your objectives, it may be crucial to research an asset's kind and purpose before engaging with it. Digital assets weren't all made with investments in mind. Are digital currencies permitted? The globalization of the cryptocurrency business has prompted the need for regulation. The American government has increased its monitoring of space throughout time. Following the frenzy of 2017 and 2018, the Securities and Exchange Commission, SEC, tightened regulations on initial coin offerings, or ICOs. Other American organizations, like the Commodity Futures Trading Commission, CFTC, have also participated in various roles. Additionally, due to changing regulatory standards, crypto regulation outside of the United States has evolved over time. For instance, the fifth Anti-Money Laundering Directive from the European Union mandates that cryptocurrency purchasing, selling, and other operations in particular countries must adhere to specific rules. Since the cryptocurrency sector is very young compared to other sectors, there isn't currently complete legal clarity about the criteria for all facets of the industry. Asset categorization is one aspect of such clarity. Although many other assets are still not clearly classified, Bitcoin and Ether are seen as commodities. If you find this video useful, don't forget to like and subscribe to our channel.